The temptation to pull $50,000 out of your home to pay off debt or renovate your kitchen can be overwhelming, but a VA cash-out refinance is not free money. Unlike a standard streamlined refinance, a cash-out requires a full appraisal, a deep dive into your credit, and a massive funding fee that could cost you thousands up front. In 2026, the VA funding fee for a subsequent use cash-out is a staggering 3.3%, which is added directly to your loan balance before you even see a dime. You're also effectively hitting the reset button on your mortgage, turning your remaining 20 years of payments back into a brand new 30-year debt cycle. If you are trading a 3% interest rate from a few years ago for a 6% rate today just to get some cash, you are making a massive long-term mistake. The total interest you will pay over the life of that new loan can often be 4 times higher than the actual amount of cash you took out at the closing table. Before you tap your equity, you must calculate the break-even point and ensure that the debt you are paying off has an interest rate significantly higher than your new mortgage. Visit VAMortgageSpecialist.com to use our cash-out reality check calculator and subscribe to protect your home equity from expensive lending traps.